Open your banking app, look at the balance. Maybe it's $5,000. Maybe it's $50,000. You look at those numbers and your brain tells you a simple story. That is my money. It is sitting in a vault, waiting for me to spend it. But what if I told you that is a lie? What if I told you that the moment you handed your cash to a bank teller, or the moment that direct deposit hit your account, the money legally ceased to be yours? In the eyes of the law, you are not a saver. You are a creditor. And the bank, they are a borrower. You have loaned your life savings to a corporation that gambles with it, leverages it, and as history has shown us time and time again, often loses it. We live in a system built on the illusion of ownership. From the gold confiscation of 1933 to the bail-ins of modern Europe, history is screaming a warning that most people are too comfortable to hear. Welcome to Money Stories. Today, we are going to expose the legal and historical reality that proves you don't actually own your money. You merely have permission to use it for now. To understand why you don't own your money, we have to look at the contract you signed but probably never read. When you deposit money into a bank, the legal title to that money transfers to the bank. It becomes their asset, not yours. What you hold is a liability of the bank. You hold an IOU, a promise to pay. But here is the catch. The bank does not have the money to pay everyone back at once. This is the mechanism of fractional reserve banking. For decades, banks were required to keep a fraction of deposits on hand, usually around 10%. But in March 2020, the Federal Reserve in the United States reduced reserve requirement ratios to 0%. Let that sink in. The requirement to hold your money is 0. So if the bank makes bad investments, if they bet on commercial real estate that collapses or bonds that lose value and they go insolvent, where do you stand in line? You are what is known as an unsecured creditor. Secured creditors get paid first, bondholders get paid, even the lawyers get paid. You are at the bottom of the food chain. You might say, but wait, what about deposit insurance? What about the FDIC? The FDIC has a reserve ratio of roughly 1.3%. They have pennies for every $100 of insured deposits. The system works only on faith. It works only if a few banks fail. If the system fails, the insurance is just words on a piece of paper. But you don't have to take my word for it. We just have to look at what happened when the government decided that ownership was inconvenient. Let's travel back to 1933. The Great Depression is raging. The banking system is collapsing. Americans did the logical thing. They didn't trust the paper money, so they held gold. Gold is the ultimate form of ownership. It has no counterparty risk. It is nobody's liability. But the government needed to print money to inflate their way out of debt. And they couldn't do that if citizens were holding the real standard of value. So, on April 5th, 1933, President Franklin D. Roosevelt signed Executive Order 6102. It became illegal for a United States citizen to own monetary gold. Think about the audacity of that. The government didn't just say, "We are taxing you." They said, "That physical object you worked for, hand it over." Citizens were forced to exchange their gold for paper dollars at a rate of $20.67 per ounce. Once the government had all the gold, they immediately revalued it to $35 an ounce. Overnight, they stole 40% of the purchasing power of every saver in America. It wasn't a robbery in a dark alley. It was a robbery signed into law by the president. This proves a fundamental rule of financial history. When a government is drowning in debt, your private property becomes a public resource. And if you think this is ancient history, let's look at what happened in Europe just a few years ago. The year is 2013. The place is Cyprus. The banks had gambled on Greek debt and lost. They were bankrupt. Usually, in a crisis, governments do a bailout. They print taxpayer money to save the bank. But in Cyprus, the IMF and the European Union decided to test a new strategy. It was called a bail-in. Instead of looking outside for money, the banks looked inside. They looked at the depositors. If you had more than 100,000 euros in the Bank of Cyprus, almost 50% of your money was seized overnight. Gone. In exchange, you were given shares in the failing bank shares that were effectively worthless. People went to sleep thinking they had retirement savings. They woke up owning equity in a bankrupt casino. Here is the terrifying part. Cyprus was not an anomaly. It was a test run. Following 2013, the bail-in mechanism was written into law across the Western world. In the US, the Dodd-Frank Act. In Europe, the Bank Recovery and Resolution Directive. Laws are now in place that legally allow banks to recapitalize themselves using your deposits during a systemic failure. The Cyprus scenario isn't a glitch. It is the new operating manual. So, we know the banks don't really hold your money, we know the government can confiscate physical assets like gold, but the final nail in the coffin of ownership is coming next. Central bank digital currencies, CBDCs. Right now, if the bank freezes your account, you still have cash under the mattress. You still have a physical option. But CBDCs are not just digital versions of the dollar or the euro. They are programmable tokens. With CBDCs, the issuer controls the ledger directly. Imagine money that has an expiration date to force you to spend it to stimulate the economy. Imagine money that cannot be used to buy certain items because you've exceeded your carbon allowance or because your social credit score is too low. This is the transition from money as an asset to money as a voucher. In a CBDC world, you don't own money. You have a government-granted privilege to transact. And privileges can be revoked. The illusion of ownership is about to become a prison of permission. So, where does this leave us? The point of this analysis isn't to make you panic. It's to make you prepare. History shows us that ownership on paper is fragile. It relies on the stability of institutions, the honesty of politicians, and the solvency of banks, three things that are in short supply during a crisis. Real ownership requires removing counterparty risk. It means holding assets that don't rely on a promise from someone else. Gold, silver, land, Bitcoin held in self-custody, skills that cannot be inflated away. The illusion of ownership works as long as the music is playing, but when the music stops like it did in 1933, like it did in 2013, the only things you truly own are what you can hold in your hand or what you hold in your head. The ledger of history is clear. If you don't hold the keys, you don't own the coins. This is Money Stories. Follow the money, and you'll find the truth. See you in the next one.